Welcome back to Technical Analysis Simplified. My name is Michael, and we're going to talk about how professionals make eye-watering gains when the market's getting crushed, exactly like we can see at the moment. I'm of course talking about short selling something you don't own, waiting for the market to fall, buying it back cheaper and still profiting the difference. Now, if this is a new or confusing concept to you, then don't worry, that's what we're going to be covering in this video. And if you're also thinking that, hey, isn't it too late? The market's already been down for 6 months. Well, going by the Bitcoin dominance chart, there's set to be a lot more pain for the altcoin market because this chart here is still trending up strongly, meaning Bitcoin's taking market share away from alts, and alts are likely going to continue getting crushed. Now, I have just 3 examples of the chart of a few of the major altcoins being Cardano, Solana, and Avalanche. And as you can see across their board, they're all roughly down in their mid 80% from their all-time highs down to the most recent lows. But as you know, things can continue to fall by significant percentages no matter where the price is. So in this case here, I just have an example of if these markets do fall down to the next resistance level or their next support level, there's still a chance of another 60+% decline from where they are at the moment. Now, of course, this could be the low in the market and they could reverse and start to go up. I'm not making any prediction on the direction of the market, but I want to cover what short selling is, a few of the risks and downfalls and what to look out for, and just how it kind of works in general. In addition, I'll touch on how I look for short trades, finding those ones that are likely going to fall more. And also the whole idea is I just want to shed some light on short selling to hopefully remove any barriers you have about what actually goes on. I'm not a financial advisor, so everything I say is general information and for education and entertainment purposes only. Trading and investing is incredibly risky, so you must always do your own due diligence, seek your own professional help and guidance before making any decision in the market. And past results are not indicative of future performance. Not all exchanges allow shorting the market. Spot-only exchanges only allow you to buy long and then sell at a higher price to make a profit, whereas you need something a little bit different to short the market. Bybit's my go-to crypto exchange for going long and short, but they also do allow spot trading as well. Bybit are currently running a giveaway exclusive to viewers of this channel and also Jason's channel. There's 2 ETH to give away to 4 viewers, so that's half an ETH each. All you got to do is open your account using that link in the description below and deposit at least $10 of fiat or crypto equivalent, and it's drawn on the 8th of June. Before we go down the rabbit hole of short selling, we'll look at the definition, and a great resource to keep in your bookmarks is Investopedia for all your trading and investing terminology. Now, the way I use short selling is to profit from a falling market, but there's actually other use cases such as hedging a portfolio. Now, what that means is maybe someone's holding a lot of Bitcoin that they don't actually want to sell, but if they don't want to see their Bitcoin value go down, but they think the market is going to go down, they can actually short Bitcoin somewhere else and hedge their position. Meaning while Bitcoin's falling in one account, they're losing money there, but if they're short in another account, they're making profit there, netting out the difference. That way they don't have to sell their actual Bitcoin in their other account. That's one example of hedging a Bitcoin position, but shorting and hedging is used in many markets and economies. Just think about airlines who set prices for an airline ticket well into the future. They don't know what the price of oil is going to be when that flight is obviously taking off, but they can know what price of oil they're locking in today, and they can hedge their position. That allows them to forward plan knowing that they're going to be making a profit on those flights in the future based on the price of oil today. Farmers also hedge to lock in profits on a crop they're not yet ready to harvest. So there's many use cases for shorting, and hedging is one of them, but what we're talking about in this video is the speculation side, purely looking to profit from the market falling. One of the main risks with shorting is, in theory, there's unlimited risk, because if you're selling something and the market continues to go up, it can continue to go up indefinitely and that loss can just continue to mount. Whereas in the traditional sense, when you buy something, the maximum amount you can lose is from that point you buy all the way down to zero. Now that we've got ahead of ourselves and looked at use cases of shorting the market, how it's used in the economy to lock in future prices for companies to do business, what we're going to be looking at is a speculation example of how it works in trading. But first we'll go through a regular buy only or profiting from a rising market. Now it's pretty simple and pretty obvious. You want to be buying low and selling high to make a profit. So just as a quick example, we've got Bitcoin here purchasing at about $29,660 and then selling when the market started to break down at about $30,050. In this case here, it would be taking the sale price away from the purchase price, and you can see there's a profit of $390. Now let's say this trader was extremely confident, or he had a trading plan that said the market was likely going to fall. There was very high probability it was going to fall away from this particular point here, but he didn't have any Bitcoin to sell, or he wanted to make a profit from the market falling. In this case here, he would short the market. The way he's able to sell something he doesn't own is through a broker or an exchange. Now what the exchange does is they borrow some Bitcoin in this case, lend it to the person trading, then he's able to sell it. Now, if you've sold something you don't own, you're going to have to return it eventually. And the way he can close out his position and either take a profit or loss is by buying it back and then returning what he initially sold. Now, this happens all in an instant. The exchange will have some kind of stock on hand, whether it's Bitcoin or any other asset, to lend whoever wants to short the market. That way there, it's all pretty much instantaneous. In traditional markets, what brokers can do is actually borrow assets from whatever they're holding in their book from other clients. But of course, part of the condition is they always have to return it back to their client's book that weren't using those stocks or whatever it is that they were actually lending out on their behalf. But back to our example here, this particular trader was right on the market. He borrowed some Bitcoin he didn't have. The market fell and then he wanted to make the profit from the difference. So in this example here, the trader was able to sell at $30,050. He borrowed that from someone else. Then he bought it back for $29,860, then returned that initial Bitcoin that he borrowed. But he was still able to profit the difference in the middle. So what that looks like in terms of numbers is simply $30,050, take $29,860, still able to profit $190 per Bitcoin on this particular short sale. So in this example here, the trader was able to make money from the market going up. Then he shorted the market and made it from it falling as well by selling first and then buying back at a cheaper price. But like we looked at in the introduction, shorting in theory has unlimited risk because after the person borrows something from someone else and sells it, the price could go up indefinitely. And if this trader fails to buy back to return the Bitcoin that he borrowed, if Bitcoin was to reach $100,000, he'd be in debt almost $70,000 because 100,000 take 30 from where he initially borrowed is 70K. But on the flip side of the market, going long, you could buy at 29,660. And in theory, if the price fell to zero, this particular trader would only lose $29,660. It's for that reason there that it's so important to always use stop losses in the market. That's both true for going long and going short, always having some kind of backstop so that the risk is known based on the stop loss position. So in the case of going long in the market and buying, maybe there's a stop loss down below some recent support levels, and going short in the market, there's a stop loss above some previous resistance levels. But nevertheless, since there is the inherent risk of, in theory, unlimited losses, that's why shorting is deemed to be quite risky. So shorting certainly isn't for everyone because obviously it just does multiply the amount of decisions one has to make. But professional traders, they're looking for opportunities both up and down, which is why shorting is part of any trader's toolbox. Now, when it comes to finding markets that are weak and are probably going to keep falling, the thing I love about technical analysis is that it works for both sides of the market. The tools show strength and weakness, and obviously markets that are inherently weaker typically have a greater probability of falling. Now, the 50% tool is one that I use a lot on this channel and also in my personal trading and investing. And what I typically look at is the market being strong in the top half of the tool and weak in the bottom half of the tool. Now, that doesn't mean I'm just only buying and only selling depending on which half of the tool it's in. It's just a strength and weakness indicator that gives me some insights into whether the market's more likely to hold up or break down. Other ways I look for strength and weakness to rate whether the market's more likely to go up or down is something like a simple trend line, connecting a few significant tops and bottoms, projecting them forward, and then looking for future strength and weakness or also support and resistance. So as you can see here, the market is just grinding within a tight range. It is getting tighter. It eventually will have to break out. It's just a matter of being patient and seeing which way it breaks out. But what I'm looking out for confirmation as well is things like higher tops and lower bottoms, all the usual stuff I talk about on this channel. So while the markets have been down now for over 6 months, the Bitcoin dominance does continue to trend up, meaning altcoins are likely going to get crushed even more. So that being the case, I'm always being prepared for whether the market's going to bounce or fall, and being able to buy long and sell short just gives me more options in the market. Now, I do want to highlight once again the dangers of short selling because in theory, there can be unlimited losses, so it's definitely not for everyone. But if you have been wondering what short selling is and how professionals use it to profit from the market, I hope this video has given you some insights. So I hope you enjoyed this video where we scratched the surface of short selling, looked at how it's used in speculation and also in the economy, while also looking at different strength and weakness indicators of how to judge whether the market's likely to continue going up or continue falling, although that's the kind of stuff that I cover on the channel all of the time. If there's another topic you'd like me to include in these videos, leave a comment in the comments section below. Remember, you can go on the draw to win 1 of 4 prizes of half an Ethereum by using that Bybit link in the description below. Make sure you deposit at least $10 or crypto equivalent or more before the 8th of June to go on the draw. And once again, thank you for joining me, and until next time, I'll catch you then.